Hello colleagues, today I want to share with you a tool that has become a cornerstone in trading for many people. We're not talking about a magic button, but about a deep understanding of what's happening on the chart. You've probably encountered the classic, almost frustrating situation. The price consolidates nicely, you see a clear level, there's a breakout on volume, you enter the trade feeling confident, and then everything just stalls. There's no movement, the breakout turns out to be a fake, and the price reverses and goes against you. This is a classic false breakout, and the reason for it is often that we see the breakout itself, but we don't see the backstory. We don't know who was building up strength inside that range or how they were doing it. Today, I'll show you an indicator that adds this critically important layer of information, the layer of intentions and the real strength of the market participants. Traditional tools for working with breakouts, like Donchian channels or breaking the high-low of a range, answer the question of where'd the price break out of the flag? That's important, but it's not enough. The indicator we're talking about answers the questions of who and how. Who was in control inside the consolidation? How are the forces of buyers and sellers distributed before the decisive move? Its logic is like that of a detective who studies the crime scene, not just states the fact that a crime was committed. This is a shift from passively watching lines to actively reading the market micro-profile. Let's add this indicator. Open TradingView. Any liquid instrument will do. For demonstration, let's take ZUSDT on the 15-minute time frame, for example. You can choose your own. Open the Indicators tab, type Volume Sentiment Breakout Channels in the search bar, and add this indicator. What do we see on the chart? First, during periods of low volatility and price compression, the indicator starts drawing rectangular zones. It doesn't do this random. These channels are built based on an algorithmic calculation of normalized volatility, which eliminates subjectivity. It's not just a random rectangle, it's a zone where the market actually paused. But the real magic is inside. The space within this channel is divided into many thin horizontal layers. For each layer, the script analyzes the entire volume that passed through while the price was within that range and classifies it. Was this volume on rising candles, buyers, or on falling ones, sellers? The result is a color gradient. Green tones mark zones where buyers dominated, while red tones show where sellers set the tone. This isn't a static image, it's a live heat map of intentions within the range. Besides the gradient, pay attention to three important elements. The first is the dashed median line running right through the center of the channel. This is the balance line within the zone. It serves as an excellent dynamic level for assessing the strength of a move after a breakout. The second element is the text labels. The indicator displays a red summary in real time, sentiment bullish or sentiment bearish, which is the final interpretation of the volume data. This is an instant hint. The third element is activated after a breakout. These are the tracking lines. As soon as the breakout is confirmed, lines start to extend from the edge of the channel, updating with each candle, visually highlighting the new trend and helping to keep the chart uncluttered by unnecessary drawings. The entry signal isn't just the appearance of an arrow, it's the culmination of a process. An up or down arrow only appears when the price closes a candle outside the channel boundary. At the same time, if you have the strong closes only setting enabled, the indicator requires that the candle not just touch, but confidently close beyond the boundary, filtering out false breakouts. But most importantly, this signal must be in agreement with the internal picture. An upward arrow is especially valuable if the channel was mostly green before that. This means that the breakout is being made by those who have already shown activity. It's a logical continuation of their actions. The indicator is very flexible. Let's go through the settings that actually affect how it works. Strong closes only is the most important filter. I always recommend keeping it enabled, especially on lower time frames. It makes the indicator ignore candle wicks and noise, taking into account only full closes. Normalization length is the heart of the algorithm. This parameter determines the period over which volatility is measured to calculate the channel boundaries. A lower value, like 20 to 50, makes the channel more sensitive. It'll show up quickly during minor corrections and just as quickly repaint. Perfect for scalpers and intraday trading during active sessions or on crypto markets. A higher value, like 200, makes the channel more stable and smoother. It will highlight only truly significant consolidation zones, ignoring minor pauses. This is the choice for swing traders, and those who work on the 4-hour chart and higher. There are also visual settings. I recommend leaving them as they are. These are important data sources, and they need to be easy to read. Now, let's bring it all together into a complete system. Let's imagine a scenario for buying. Observation phase. A channel where box is forming on the chart. We're not rushing. We're watching how its inner space fills up. We need the gradient to become mostly green, especially in the upper part of the channel. This indicates aggressive buyers at the resistance level. The text label should show bullish. Signal waiting phase. The price may approach the upper boundary several times and bounce back. That's normal. We're waiting specifically for a confident candle close above this boundary. At that moment, an upward arrow appears. Entry point. You can enter at the close of the signal candle or on a small pullback to the broken boundary, which now becomes support. Stop loss. The most logical places are either right below the middle line of the channel. If the breakout was strong, the price shouldn't come back that deep, or below the lower boundary of the channel itself. That would be a complete invalidation of the pattern. The choice depends on your risk tolerance. Taking profit, you can set your target at a risk to reward ratio 1.5 to 2. This guarantees a profitable trade. Let's look at the result. As we can see, the setup turned out to be a winner. For selling, everything's exactly the same, just in the opposite direction. We watch for the formation of a channel with a red bearish gradient, especially in its lower part. We wait for a confident candle close below the lower boundary and for a downward arrow to appear. We enter at the close or on a pullback. Set your stop above the middle line or above the upper boundary of the channel. You should aim to set your take profit at roughly 1.5 to even 2 times the amount of your initial risk. As we can see, the situation worked out in our favor. Practical life hacks. First, trust the middle. The middle line is your best friend for assessing the health of a trend after a breakout. If after a breakout to the downside, the price immediately rises and holds above the middle line, that's a weak breakout. Don't be afraid to exit such a trade quickly, even if it means taking a small loss. Second, combine it with context. The indicator gives you fantastic micro contacts, but don't forget about the macro contacts. The overall trend on the higher time frame, key support and resistance levels. A breakout in the direction of the overall trend has greater potential. Third, adaptability is the key to success. Don't use the same settings for different markets, like currency pairs and cryptocurrencies. Crypto may require a shorter normalization length, while currency pairs may need a longer one. Fourth, it's primarily a filter, not a signal generator. The main value of the indicator isn't in giving more frequent signals, but in filtering out the bad ones. It teaches patience and selectivity. Sometimes you might sit the whole day without making a trade, because not a single breakout was confirmed by the right internal setup. And that's a good day. For me, as a trader who likes to understand the essence of things, a huge advantage is the open source code of the script. You can look under the hood and see exactly how volatility normalization is calculated, and how the direction is determined. This level of transparency inspires trust. You're not buying a pig in a poke, you're using a clear and customizable tool. This video is not financial advice, it's a demonstration of an idea. Be sure to backtest this approach on historical data. Start with small volumes on a live account and keep track of your observations. The indicator gives you a powerful microscope for the market, but the decisions about entry and exit, as well as capital and risk management, are always your responsibility. If you found this video helpful, please like and subscribe to the channel. That's the best feedback you can give. Thank you for taking the time. See you in the next video.